Welcome to Dukascoin TV's on finance. For over a year now, we have seen the Chinese tech stocks tank from all-time high. Now, if you're investing, or maybe you know your family or a friend has invested into Chinese tech companies, they're probably having a rough year. So show them compassion, send them gifts, hug them, because they're going through hell on earth right now. Chinese technology stocks are facing major difficulties. E-commerce giant JD.com is down almost 50% from its all-time high, and Alibaba, its rival, is down more than 60% from all-time high. Take a look at Hang Seng's tech index, which includes some of China's largest tech companies. All of that after a brief recovery of the Chinese tech stocks in mid-March. And here they are, back to struggling again. But what could have caused this big sell-off in the tech stocks in the world's second largest economy?
There are a number of negative factors affecting Asian tech stocks right now. The three biggest concerns are, firstly, the COVID-19 issues with Shanghai and what that means for China in the near term, which is having a downward pressure on the Hang Seng and the Chinese stock markets. Secondly, and following that, you have the US, which is taking measures against Chinese tech stocks that have listed in the US, and some are actually just being delisted completely, being sent back to Asia and causing concerns for investors globally. The third, of course, is the current issue with Ukraine and Russia and the impact that's having on global energy prices and overall investor confidence.
Now, Chinese tech stocks going down the drain can be associated with several factors. The Chinese government tightening regulations that govern Chinese companies outside of China's shore is one of them. The regulations will further scrutinize cross-border data flows and security overseas. From the rejection of Ant Group's $34.5 billion listings to Alibaba's $2.8 billion antitrust penalties, Beijing has been hitting local tech giants in recent months. The focus has been mostly on antitrust and financial technology regulation. Because data is so important to the tech industry, which is a crucial engine of economic growth, regulators are now focusing their attention on it. Also, Tencent, the parent company of the popular WeChat app and one of China's largest digital businesses, appears to be facing a significant punishment for violating China's anti-money laundering regulations, indicating that Beijing's regulatory campaign is far from complete. Now, apparently, Beijing sees offshore-listed tech companies as a potential threat to national security. So now we also see Washington's lawmakers and regulators push further for monitoring these Chinese listings in the US. So the Chinese tech stocks slumped as a group after the Securities and Exchange Commission said 5 Chinese businesses would be delisted from US stock exchanges by the end of the month if they do not comply with the US auditor disclosure regulations. Now, is that the only issue? Don't think so. To add salt to the wound, the Chinese economic and political alliances with Russia have raised the concern for possible chances of economic sanctions on China if it provides military aid to Russia in the ongoing Russia-Ukraine war. Now, China's possible plans to offer military and economic help to Russia in order to combat the harsh sanctions imposed by Western countries following Russia's invasion of Ukraine do raise a lot of concerns in the minds of investors. Now, it's unclear how China would go about it, but of course many believe that providing material help to Russia may lead to some serious penalties from the US, European nations, and many other countries, severely squeezing China's economy at a vulnerable moment. Also, to tackle a COVID-19 epidemic as part of the zero COVID tolerance policy, China did shut down its industrial powerhouse of Shenzhen. This also directly impacts the equities markets and adds to the supply chain and geopolitical worries that might force some production out of China. Now, public transportation has been banned, and officials have advised citizens to stay home until 3 rounds of mass testing are conducted. As a result of the action, Foxconn, an Apple supplier and iPhone manufacturer, has halted operations in the city. So what are investors' and analysts' reactions?
To the question, why do Asian tech stocks keep tumbling, I would answer, look at what's going on in the world. It's very unstable. We have inflation up to 12% in Europe. We have a risk in Ukraine, we have a trading risk, a transport risk. We have permanent lockdown in China, in Shanghai. So I don't think there is any confidence in the markets now, unless there is stability and also the reliability of transportation and supply chain.
Beijing's zero-COVID policy is expected to intensify the economy's slowing growth, which is already slowed by falling property sales and rising commodities prices. The rally from March 15 lows sparked by Vice Premier Liu He's commitment to boost the economy and equities is fading. China policymakers don't want the market to fall any further, at least not in the stomach-churning manner that preceded the sudden turn. Given the president Xi Jinping is expected to pursue a record-breaking third term as the Communist Party's leader this fall, economic stability will be a policy priority in 2022. There's no way of knowing when or if the massacre in the Chinese tech stocks will stop. There are many reasons why investors are abandoning the industry, and any of them might continue. If the market makes a recovery, it should be able to headed by stocks like JD.com, a majored, well-established growth business that has escaped the Chinese government's wrath thus far. However, with stocks like JD.com taking a beating in the recent days, investors are probably better off waiting for things to calm down in China's tech industry before investing. There's a significant risk that things may get worse before improving.
Stock market actually did start to move up today, and economic growth for the last 3 months are 4 or 5%. So things are perhaps a little bit brighter, and it's quite likely to feed over into stock prices, especially for tech prices. And of course, in Asia, don't forget the other big country, which is China, which has had some problems up to now, but is likely also to recover as they've poured massive investment into technology and are very adept and very skillful at marketing and selling it. So watch out more for India, I think, in the future.
And that's all we have for this episode of On Finance. Look, make sure you keep yourself up to date with all kinds of financial news updates on all of our social medias and support your future financial investment. I'll see you on the next episode. Thank you.